Okay, today we're going to start a new chapter, Chapter 21, Capital Investment Decisions and Time Value of Money. So remember last week we covered some of the decisions on short-term business decisions. So do you remember any of them? A few? Remember we started from special orders, then we had pricings, whether to drop a department or not, what type of products that we want to emphasize, the ones with more contribution margin. And then we also had outsourcing decisions, whether to sell a product as it is or process it further, right? Some of the short-term decisions that usually are made for just that current season or the future seasons, the near future. So some of the decisions we want to make in this chapter, we're moving on to a longer time frame. Okay, so the considerations will be a little bit different, and the tools that we'll be using is also different. Okay, so you'll be introduced in this chapter 4 different analysis tools to determine whether or not we want to invest in this long-term assets. Okay, so the investment term that we use in this chapter is not referring to investment in stock or investment in bond, but rather the investment in long-term assets purchase or not. So whether to spend money on updating websites, purchasing other machinery, equipments that can help manufacturing cycle or not. And then these are some of the tools that you'll be introduced in different sections to determine whether or not, again, it's a cost-benefit analysis. So whether the money you're spending on this long-term asset actually provides us enough return and exceeds this cost that we spent earlier. So the whole point of investing in something, hoping to get more return out of it. Okay, so first section will be describing what is capital investment, what is the general process of doing capital budgeting for long-term assets investment decisions. And then we'll be using payback period, rate of return methods, the first two methods that usually is used for long-term decisions but relatively in a shorter time frame. So 3 to 5 years decisions in a shorter lifespan, we'll be using these first two methods. Third and fourth, we'll be factoring in time value of money. So we'll be calculating present value, future values, annuities. With some of the concepts perhaps you also learned in other finance courses, we'll be combining this with managerial accounting concepts. So first of all, what is capital budgeting? This is the decision that companies, managers need to make on whether or not to invest money in long-term assets projects. So they will be evaluating which type of projects will provide them the highest profitability and then aim toward investing money in that project. So you may have several options, alternatives. The same as short-term business decisions. Remember, we may be purchasing from different supplier, different vendors. You'll be getting a different price. So which one at the end gives you the most profitability, that's the one that managers will want to invest money in. Okay, so these long-term investment decisions, perhaps, for example, could be developing websites, could be updating, upgrading some of the machinery, purchasing a new facility, new manufacturing plant, automating some of the production steps that in the past perhaps was manual processes in the past. So some of the examples here, again, the investment we're referring to here is not purchasing stock, not bond purchases or long-term debt, short-term debt. We're referring to the investment in assets. Okay, so who remembers statement of cash flows in financial accounting? Do you remember any of the structure? General structure. There's an operating cash flows. And we also have investing cash flows. There's also financing cash flows. Remember, statement of cash flow is all about money in, money out, cash part. Operating reflects all the sales, revenue, expenses, cash inflow, outflow. Investing section, the second section is statement of cash flow. Investing section refers to the money that you're using to purchase long-term asset and the money that you're collecting if you sell long-term asset. So here, all the investing term we're referring to here is referring specifically gearing toward long-term assets purchase. And we're trying to figure out whether the money we're spending on this long-term asset upgrade or purchasing new machinery actually gives us additional profit later on. And that profit exceeds the initial cost. So we're comparing which one is higher. If we're getting more profit out of this investment, then of course it's a good project. We can go for this project. If overall the profit is not high enough, doesn't even cover the initial cost, then there's no point to upgrade these websites or update this, or upgrade or purchase new equipment, machinery if overall the return is not enough. Okay, so we'll be weighing the two between initial cost investment and the return that we're getting from the asset. But again, this long-term asset affects longer time frame. It could be 3 to 5 years, 10 to 20 years. So we want to know what is the estimated value as of now. Okay, so these tools will be helping us to look at different angles of the projects. What is the time period that we're getting the money back? Or what is the rate of return that we're getting? And of course, for longer time frames, assets investment, what is the present value as of now? Here? We'll be going over this in detail, but it's average annual operating income. Okay, and this is annual average investment that you made. Okay. Okay, so overall this chapter we're surrounding on 4 tools here. Payback period, rate of return, net present value, internal rate of return. So we'll be going over each and every one of this in details in terms of formulas, exercises that links to how we actually use the tool. But generally speaking, just to give you a heads up, again, first 2 methods are usually used as a screening process. So usually are not used alone, especially for some of the investments that last for 10 years or 20 years. As long as it's more than 5 years, usually we also combine it with a 3rd tool and a 4th tool, considering time value of money also. Okay, so payback period simply just understands what is the time frame that we're getting the money back from this investment of assets, time period. Rate of return, moving toward profitability side, what is the profit that we're getting out of it comparing to the investment toward this project that we made earlier. Present value, internal rate of return, we'll be considering present values, considering the interest rates, time period, referring to some of the annuity tables to figure out what is the present value factor, future value factor, and what is the present value of this investment project based on the estimated return that we make. Okay, so all of these tools we're trying to project and estimate. Remember the key term here is estimation. What is the estimated cost that we're spending? What is the estimated return that we're getting? So it's not really the exact number. So in reality, of course, in the problems that we go over in class, we assume that the return is the same. We assume that we already figured out every single year's return. But in reality, sometimes the numbers, we need to adjust it as time goes by. So perhaps when it moves to 2nd year, we need to adjust it. We realize this asset is not really giving us $60,000. It's just giving us $50,000. Then we need to do further adjustments. So just keep this in mind that all of these is a process of estimation. So we're estimating different alternatives, different options, which one gives us the possibility, highest profitability. Okay, now all these tools here, we're pretty much all focusing on cash inflows, besides the 2nd rate of return, which we focus on operating income. Operating income is actually an accrual accounting tool. Remember the idea of accrual accounting? In financial accounting, we talked about the difference between accrual accounting and cash-based accounting, right? So accrual accounting links to the concept that we may have accounts receivable, which is not cash yet, but we still consider it as asset. Accounts payable, not actual cash payment yet, but we still consider it as liability, right? So for all these 4 tools, only the 2nd one we refer to accrual accounting based, operating income. All the remaining 1st, 3rd, and 4th, just to give you a heads up, it's focusing on cash inflows, cash outflows. The differences between the cost that we're saving, the cash that we're receiving, against any operating expenses that we're spending. The differences we call the net cash inflows. Okay, so if we update the website, What is the potential revenue that we're getting from that? As customers are better able to see our products from the updated website. They can do more purchases. What is the projected sales revenue increase there? That's the cash inflows. But what about the people that we hire to maintain the website? Are we spending additional labor cost on this? So the differences between the inflow and outflow, we call it a highlighted term, net cash inflows. That's actually the base for most of the analysis we'll be doing a little bit later. Okay, now, so the main difference between net cash inflows and the operating income basically falls under depreciation expenses. So remember that assets, we usually measure how long it can be used in the business, and we may be depreciating it by a straight line method, typically for furniture, for buildings. Some of the machines, if it helps us manufacture certain products, we may be depreciating it by units of production, right? So depreciation expense is really not a cash that we're spending or paying anybody. It's just a measure of degrading the value of assets. Okay, so at this point, keep this in mind because later when we go over some of the tools, sometimes we use operating income, sometimes we use net cash flow. The differences between these two really is just the depreciation expense. Operating income is an accounting measurement, so we usually consider depreciation expense in this. We minus depreciation from net cash inflow. So this is just pointing out, reviewing some of the concept differences that you learn in financial accounting. Probably it's a little blur right now. Just keep in mind that cash inflow, outflow doesn't represent the accrual accounting income and expenses. Remember that depreciation expense also factors in operating income. Okay, so this is the inflow, the cash revenue that we're receiving, but we also have expenses that we usually depreciate every single month, especially on long-term assets. That will reduce the inflow, become operating income later. But mostly, generally speaking, all the four tools besides the second one, rate of return, we're using operating income. All the other ones we're focusing on cash inflow, outflow. What is really the present value of the return that we're getting from investing in these long-term projects. Okay, so here just a highlight of a general decision-making process from management level. First of all, they start from identifying which areas they may need to put more effort in, spend money on investing different projects. So again, for example, upgrading the website, purchasing new tools, perhaps updating Windows 7 to Windows 8, or perhaps later on to Windows 9. And then what is the potential return they're getting out of this? They want to estimate the net cash inflows. The savings they're making minus any potential operating expenses spent on maintaining this upgraded machine or upgraded website. So identify potential projects that they want to spend money on, capitalizing the business. Estimate what is the inflow, outflow, and then they base these estimations on the tools that we'll be learning in different sections in this chapter. So that's the third step. Analyze investing using different tools, long-term investment tools. After analyzing those, you'll be getting some of the ratios, weighing some of the net present value against the investment cost. What if some of the projects have, all of them has positive present value or positive profit? Then they have to exercise capital rationing, meaning to choose which projects that they really think is more urgent than others. Okay, some of them, if upgrading the website allows the company's products to be exposed to further customers, then of course this is probably more urgent than upgrading some of the, or renewing some of the furnitures in the business. So what are the ones that they think is more important? They decide to implement that first, spend money on this first. After implementing some of the projects, on a yearly basis, they also need to evaluate it. So that's what we call post-audits. So evaluating the projects, perhaps later years, they realize that the return is not as high as they estimated before, then they have to readjust the numbers and decide whether they want to continue to invest in this or perhaps sell the asset for something else. So some of the ideas is similar to last week when we talk about outsourcing. right? We want to weigh against whether producing something in-house is costly, is it more costly than purchasing something from elsewhere? Which one actually spends more money on? Okay, so this is a general budgeting process. Again, they start from identifying what areas they need to make improvement in. Perhaps there's certain areas they need to spend money on, but they have to first of all estimate what is the net cash inflows they're getting out of this. Are they spending money on the place that they should be spending? Is there profit coming along with this? So if there is, based on the analysis tools they make afterwards, if they realize that there are certain projects that are all getting positive profit out of it, which one is more urgent than others? So is upgrading the website more urgent than purchasing new machines? If it is, go for that project. But after implementing it, they also need to constantly evaluate it to see whether they want to terminate certain projects, sell it, to do something else with that money, or they want to continue it further on the project. Okay, so this is just the grounding of what we're doing in this chapter before jumping into all the different cases and analyzing the numbers. The grounding we're doing here again is try to evaluate whether spending a large number of money on certain long-term asset investment is worth it or not. So going through these steps, at the end they want to reach which other projects they want to actually implement, which ones perhaps they can leave it out for later years. All right, so just to refresh your memory a little bit, what is the first step here for what we're doing in this chapter? Identifying the potential projects, and then what's the second? The second is estimating net cash inflows. So it's none of the options, right? So first of all, identifying the projects, and then do an analysis, of course, what is the money that we're actually getting from that project? Getting from upgrading the website, getting from purchasing machine, using the machine for products. Analyze this based on the tools we'll be learning later, and then choose the investment project that is most urgent and gives you the most profit. Okay, and then evaluate those projects. Okay, let's take a look at a first tool here, Payback Period. So what does this mean? This helps managers to evaluate how quickly they're getting the return back, meaning how quickly they are covering the initial cost that they spend on this particular asset. Okay, so if they spend $10,000 on purchasing a type of new equipment to help them produce more products or basically shorten the cycle of their manufacturing process, how quickly are they able to get return out of this and cover that $10,000 that they spent earlier? This is what this tool is enabling managers to identify. So obviously, if $10,000 you spent earlier in the first year, you're getting $1,000 back, then you will need 10 years to cover this $10,000, right? Because all 10 years, add them together, gives you $10,000. So then the payback period will be 10 years. So this tool simply identifies time period, nothing more than that. Not the profit side, not any ratios, just simply the time frame that they're getting the money back. That covers this initial cost that they spent on purchasing a certain machinery, certain equipment. Okay, so you can probably guess if other machinery allows you to get $2,000 every year, then you will only be spending 5 years to get the money back. So the shorter the time period it is, in a general sense, the project is more attractive. Okay, so if we take a look at this example, let's say the company wants to they have two areas to improve. Either upgrade their website or spend money on B2B portal, business to business. When they purchase materials, some of the machinery from other business, they can do this online, the B2B portal. So assuming that for both projects they're spending $240,000, meaning if they choose either one of them, they're spending this dollar amount. But in terms of the return they're getting for B2B portal, every single year they're getting $60,000. Second year is $60,000, third year is $60,000. For website, they're getting $80,000. So in the first glance, it seems like this one is more attractive than the other, right? Because if you use the initial investment dollar amount divided by the expected annual cash inflow, you're getting 4 for the B2B project. So you need to spend 4 years to cover that initial $240,000. For the second one, you're getting $80,000 for every single year, so you're only spending 3 years to get the money back. What do you think will be the potential disadvantage for using this method? So I'll give you a hint. B2B portal, the lifetime of the asset, you assume that it can be used for 6 years. For the website upgrade, it's only good for 3 years. After 3 years, perhaps you need to do another upgrade based on the current technology advancement speed. So basically, if you invest in the website upgrade, of course you're getting your money back in a quicker time frame, in a shorter time frame, 3 years. But after that, you're not getting anything else. You just covered the $240,000 and that's it. But for this project here, you're covering it in a longer time frame, 4 years, but after that, you're getting $120,000 more. So you not just cover the initial cost, you're also getting 2 more because it can be used for 2 additional years. Okay, so the downside of using simply just the payback period is that it doesn't consider any profitability that you're getting after you cover the initial cost, because you're simply just comparing 4 years against 3 years. Okay, so this method is more elementary. It's usually just used as a screening process in the beginning of identifying which project is better than the other. It's only a screening process to determine which one takes a longer time frame to cover the initial cost, which one actually covers the cost in a shorter time frame. But it does not consider the profitability after that. Okay, now this is a case that it gives you an equal time frame of return. So typically for some of the furnitures or machinery that runs on a very routine basis, usually you may assume that it gives you a certain rate of return every single year is the same. But what if some of the things that some of the machinery use depreciation on units of production? If you heavily use it, it gives you more return. So then we may estimate every single year the return rate is different. So assuming that there's another project, you may assume in a Z80 portal, and it gives you every single year a different rate of return. First year, 100,000. Second year, 80,000. Third year, 50,000. So then how do you calculate the payback period? So in this case here, we want to accumulate the savings every single year. Initial cost, for example, is still $240,000. You're spending this money on this Z80 portal. But since every single year it gives you a different rate of return, you can't just divide it by a particular random number, right? So what you do here is you'll focus on the accumulation of the savings. So first year gives you $100,000. That's the profit. Second year you have 80 more. So you add that with the 100,000, you get $180,000 after the second year. What about after the third year? 230,000. So that is getting close to the initial cost. So by the end of the third year, you're accumulating savings $230,000. Fourth year, it already went over the initial cost, $280,000, right? So it's somewhere between 3 and 4 years, you're getting the initial cost back, $240,000. So you know 3 years is a definite period that you'll need to use, because up to 3 years, you cover $230,000, then you have $10,000 left. So that $10,000 divided by the fourth year's cost, fourth year's revenue that you're generating, $50,000, you're going to determine the remaining period is 0.2 years, so about 2 to 3 months. So this is a case for unequal cash inflows. Again, for unequal cash inflows, you'll be accumulating what is the total inflow that you're getting to figure out what is the payback period, because every single year could be a different level. So you can't just divide it by a certain number. You accumulate the cost and figure the two numbers that is closest to the initial cost. So the 2 years that is closest to the initial cost is third and fourth. You know for a fact that you definitely need to spend 3 years to at least get $230,000. Then you have $10,000 more to cover. That $10,000 will be covered in the fourth year when you generate $50,000 more. So the payback period for the remaining is 0.2 years. So altogether, it takes you 3.2 years to cover the whole cost, $240,000. Now, what if I tell you that the initial cost is $330,000? Then what would be the payback period here? So you will find the two numbers that is closest to that initial cost, which is the fourth year and the fifth year, right? So you know for a fact that at least 4 years. So now the remaining part would be $330,000 minus the $320,000, then divided by 40,000, the fifth years. So this part would be 10,000 divided by 40,000, right? So it would be something like 2.5. Okay, if it's $370,000, then you'll be picking the fifth year and the fifth year and the sixth year. So at least be 5 years, and then you have $10,000 divided by $30,000 to figure out the payback period. So whatever the initial cost is, for unequal cash flows, you can't divide it by a certain number. Figure the two accumulated costs that is closest to the initial cost. So you definitely need to know that you have at least 4 years to spend in order to cover the cost, and then you have additional cost. It's between, it's between 5 and 6. I aimed at it. Yes, it's 5 plus the additional, yes. Yeah, so it's still divided by $40,000 because the 6th year is $40,000 here. So this would be 5.25. Okay, thank you. Any questions so far for this method? So this usually, since it doesn't consider the profitability part, usually it's just used as the first step to screen out some of the projects that takes too long of a time to cover the initial cost. Okay, but for the ones that are closest in the periods, oftentimes managers needs to use other methods together to determine which one is more ideal than the others. Okay, so if we look at all 3 projects together, the website takes you 3 years to cover. Remember, the website costs you, return is $80,000 every single year. It takes the shorter time frame to cover. The Z80 portal that we just did takes 3.2, the unequal cash flow one. B2B portal takes 4 years. But again, since the remaining profit is different for these 3 methods, these 3 projects, website basically, after 3 years, they don't have additional profit. The 4-year project, we still have our $120,000 out of it. 3.21 remaining profit is $150,000. But these takes different years to accumulate the profit. So just by looking at the years here, it doesn't really tell you much about which project is more ideal than the others. So we need to combine it with the methods that we'll be learning a little bit later. But it gives you an idea how quickly the money covers the investment costs, and that's about it. We can't make any decisions right now. So the decision rule here is that assuming all 3 projects has no additional profit, no $120,000, no $150,000, all else being equal, then you can compare just the time frame. Meaning if all 3 projects are like the website project, after 3 years, after they cover the cost, they don't have additional profit, then of course you'll be choosing the website project since it covers the initial cost faster. But since the 2 remaining projects has additional profit, we can't just compare it like this. Okay, so this rule here, the shorter time frame, the better, is only used if the profit level is the same for all different projects. Okay, let's take a look at the second one here. Rate of return. Now this method here does consider profitability. It's not just about, it's basically not about time frame. The first one is about time frame. Second one here, rate of return, is an accounting measure that we compare average operating income against the amount of investment we made to the asset on average. Okay, so we want to know per dollar of average investment we invested in this asset, how much return in operating income are we getting out of this? So of course this rate of return, the higher the better. We compare 2 projects. For every dollar of average investment you make in the asset, if you're getting $18 out of the first one, only getting 19 cents out of the other one, 18 cents out of A project, 19 cents out of B project, the higher the rate, the more profitability it represents, more profitable it represents. So rate of return, the higher the better, but in terms of calculating this, it's a little bit trickier than the previous payback period. Okay, so the numerator for this ratio here, see that it's average annual operating income. So remember that for all the other ratios, we're using net cash inflows. So the differences between net cash inflow and the operating income, the differences here is the depreciation part. Operating income considers net cash inflow minus depreciation expense. Okay, so another way you can look at this as it's more conservative in a sense because it's trying to reduce the income from all the net cash inflows, cash that you're receiving, but also factoring in depreciation minus this part. Because as we use the asset, we assume that the asset is growing old. So we also consider the part that downgrades the asset's value. And this numerator here, compare it against average amount we invested in the asset. So remember that $240,000 that we invested in the websites or some of the other projects. This value here plus any residual value divided by 2 is the denominator here, average amount invested in the asset. Okay, so make sure you highlight the term average here. We're not just using a single years, we're using all the years divided by whatever the lifetime of the asset is for the numerator. Okay, so the operating income that we're getting is the total net cash flow of the asset minus the depreciation, and then we divide it by the useful lifetime of the asset. So if the asset can be used for 6 years divided by 6, that gives you the average annual operating income. If it can be used for 8 years divided by 8, 10 years divided by 10. That's the numerator part. Denominator part here, we want to know what is the average amount we invest in the asset. Consider that $240,000. If there's 0 residual value, plus 0 divided by 2 gives you the average amount you invest in the asset. So this chapter here, actually, since we're doing analysis on which project, which investment plan is more ideal than others, there's a lot of numbers here and a lot of the measures that we're using. So make sure you understand fully what goes into the numerator, what goes into the denominator, and what does it represent after calculating this. How do we compare the results? Because each and every ratio actually uses a different measure. So make sure you understand the term average is used for this ratio. Some of the other ratios may not be averaging out, just looking at altogether present value and investment cost. So this particular one, we use the average value operating income and the average assets value. Compare per dollar of investment we make, how much operating income we're getting out of it. Let's apply this to numbers. So let's assume that, again, that earlier example, the B2B portal, every single year, remember, it gives us a net cash inflow of $60,000. And assume the lifetime of that portal is for 6 years. So altogether, the cash inflows we're getting overall is $360,000. And assuming that the depreciation, since it tells you that the asset depreciates and the salvage value, the residual value is 0. So the total depreciation at the end of the asset's lifetime is the entire investment that you made earlier, $240,000. The initial cost of the asset is the total part that you will depreciate, depreciable cost. So overall, the operating income you're getting out of this investment is $120,000 operating income after 6 years of using the asset. Then you divide it by 6 to figure out an average annual operating income, $20,000. Okay, so the first step here, when you look at each and every problem, ask yourself, what is the net cash inflow? So for this problem here is $60,000 per year. And you use it for 6 years. So this is the lifetime of the asset. Every single year you have $60,000. Altogether, the total cash inflow is $360,000. That's the first line here. Second, since we're comparing operating incomes, so this is only net cash inflow. We're considering using the asset, the downgrade of the asset, that downgraded value is $240,000. Meaning after we use the asset for 6 years, it doesn't worth anything. So we reduce the $240,000 to figure out the operating income, $120,000. So this is the total operating income for 6 years. And we divide it by 6, the average annual income will be $20,000. Okay, so this example is representing what's there in the upper table. A is the total cash flow, $360,000. B is the depreciable cost, $240,000. The initial cost you spent on the asset, at the end of 6 years, the value becomes 0. So you will totally depreciate the entire thing. So A minus B gives you $120,000, the total operating income for 6 years. Then you divide it by C, which is the lifetime, 6 years. So what does this give you? How does this link to rate of return? What is the $20,000? How is it used? That's only the numerator of the ratio. So you got the $20,000. What about the denominator? Average amount invested in this asset. What is the amount that you invest into the asset? Meaning, what is the price that you paid for the asset? $60,000 is the return you're getting out of it. 120 is comparing the return against the money that you spend. So really the money that you spend is $240,000, right? Remember initially when you invest in the B2B portal, you spend a huge amount of money, $240,000. You hope that it gets you return every single year, and we estimate every single year it gives you $60,000. So you total these up, gives you a total net cash inflow $360,000. Remember, the asset's value totally disappears at year end. So the $240,000, the initial cost you invested in, disappears. Overall, you're getting $120,000, and overall, every single year you're getting average $20,000. Yes, you could think of it that way. So on average, every single year you're getting $20,000 while you use this B2B portal if you actually invest in it. So the rate of return here, you use the $20,000 divided by $120,000, the average amount you invest in this asset. So this ratio here would define this average investment, the initial cost that you spend, plus any leftover value, which in this case we assume is 0. And you divide it by 2, gives you the average value of the asset. Okay, again, so all what we did in the previous slide, going through the total return of the assets minus depreciation, operating income divided by 6, all of that is just giving you the average operating income that you're getting every single year, $20,000. So after this, don't forget to divide it by average value of the investment. So we define average value of investment by beginning assets value plus the ending assets value divided by 2. So this ratio gives us 16.7%, which means on average per dollar of investment you made to the asset, it gives you 16 cents of returns. Yes, you can think of it that way. Or on average $100 of investment, you're getting $16 out of it. So we will use this to compare against different investment projects. The higher the rate of return, the better, the more attractive the project is. So of course, if the business also set in place a minimum rate of return threshold, if this doesn't exceed, for example here, if they set it as 20%, any of the projects that is below 20%, they're going to decline and reject it. Then in this case, they will reject it. So if the rate of return threshold, let's say, is 15%, and your rate of return here is 16%, then you will accept this project. Okay, so this, for each and every problem given to you, you'll be given what is the desired rate of return, and you compare this particular project against that desired rate of return. If it exceeds it, then you can accept the project. If it's lower than it, then decline it. 240,000 is the beginning, and then you plus the ending divided by 2. So you wanted this $120,000, think of it as kind of the constant value of the asset. We spread it out. So the original value was 240,000. Of course, it degrades as we use it. But we just assume overall, on average, it's $120,000. That's the worth of it. Divided by 2, because we're using average. Right, so the average of the asset's investment value will be beginning plus any residual value divided by 2. On average, what's the asset's worth? Of course, in the beginning years, they're worth more. Ending years are almost worth nothing. But on average, you're worth about $120,000. So if this problem here, if there is a residual value at the end, let's say $10,000, then you'll be using 240,000 plus 10,000 divided by 2. So it will be $125,000. If there was a residual value, 10,000 at the end, then this part here will be substituted to whatever residual value there is. So just to summarize here, again, whether or not to invest in these projects, if it's a long-term project that only affects the operation cycle or manufacturing cycle for relatively a shorter time frame, 3 to 5 years, or within 5 years, we can use the payback period plus the rate of return to make decisions here. Of course, payback period, we want to choose the ones that will give you the return quicker in a shorter time frame. For rate of return, we compare whether the return rate exceeds the desired rate of return set in the business. If it exceeds it, then it will give us a reason to invest in this project. If it doesn't exceed it, then of course we do not want to invest in this asset if it doesn't even give us our desired profit. Okay, but both of these is usually just used for the investment projects that are not longer than 5 years. If it's for 10 years, 20 years, then we have some other critical factors, time value of money, that we need to consider. Well, then we'll be using the third and fourth method, not just the first two. So the first two is simpler, it's quicker to calculate, but of course it doesn't consider time value of money. It's not factoring in whether $1 now is the same as $1 10 years from now. Obviously it's not the same. So it's not considering the value of time value of money yet. So it's only used for long-term projects that are still relatively in a shorter time frame. Okay, let's work on an exercise problem. Try to combine these two methods that we did earlier. Okay, this problem here tells you that Smith Valley Snow Park Lodge wants to invest in an expansion project that will cost them $13,500,000. And the residual value of this project at the end will be $1 million. The useful lifetime is 10 years. Okay, so based on that information, you can try to figure out the depreciation cost already. In the middle part here, you will start off from, giving you a hint, you will start off from average cash spent by each skier per day, 236 there. Meaning that is the average, think of that as the retail price that you're collecting, the revenue you're collecting from these skiers. Every single day for each person, the average cash spent by each skier every single day is 236. You'll be collecting that. $76, you'll be minusing that. That's the variable cost that you'll be spending in order to maintain the business, the operating cycle. So try to figure out the differences between 236 minus 76, that is per skiers, per day's revenue that you're getting. Then you multiply how many skiers there is every day, and then every year how many skiers occurs. Let's try to figure out just number one question, the average annual net cash inflow first. So first of all, if you want to know how much money you're collecting from this business, you need to know how many skiers are coming on a yearly basis and how much money you're getting from each skier every day. Right? So it tells you that the number of additional skiers per day after the expansion will be 117 people on a daily basis. And the average number of days per year that weather condition allows skiing will be 142. So just these two numbers here, you have 117 people and you have 142 days. So this will give you the annual passengers, or you can say the annual customers that will come to the business yearly basis. Then every single person, you'll be charging them $236. However, you also have variable cost occurred, so you minus this sales revenue by this dollar amount. So this will give you the annual cash flow that you're getting. Okay, this is just summarizing all this here. You start from the cash you're receiving from the customer, each and every person, $236, minus the variable cost that you're spending on these people, maintaining the entire skiing lodge, things like that, maintenance cost, operating cost. So overall, the net cash inflow per skier per day, you're collecting $160. The differences between these two. And then that $160 you're getting from each and every person, every day you expect there will be 117 people, customers coming. So every person you're collecting 160 times 117 people. Altogether, that gives you a daily basis of cash flow, $18,720. That's per day. Then you time the days that weather condition allows people to ski, 142 days. Okay, so this is the first step. Before calculating rate of return, we need to know, and also before calculating the payback period, we need to know what is the annual cash inflow that we're getting, net cash inflow. Remember, the differences between any revenue that we're receiving, 236, minus any cost of maintaining the place, maintaining the business, which is the $76 here. Okay, so this is similar to that $60,000 that we use for website portal. Remember, PHP portal? It's just that the problem directly gives you that $60,000. Here, we're calculating the net cash inflow on an annual basis. Okay, so this is the net cash inflow. What about operating income? We have to subtract depreciation, so how do we get depreciation from the problem then? We have residual value, $1 million, and that needs to be subtracted from the initial cost, which is the 13 million something. So 13 million something minus the residual value divided by lifetime. So the lifetime is 10 years. So because the first problem here, we already calculated the annual net cash inflow. To calculate the annual operating income, we get the annual depreciation too. Okay, so you will use that previous number, the every year's net cash that you're getting, minus any depreciation that you made. Depreciation for the asset given to you was the initial cost of the asset minus any leftover value divided by the asset's lifetime, 10 years. So every single year, the expansion that you made will downgrade this level of value. So $1,250,000. You have to subtract that from the annual cash inflow. This is given to you in the problem, the residual value. Okay, so if you go back to the problem, the residual value will give you the $1 million. Meaning, after 10 years, the asset's still worth $1 million. You can either sell it or try to rework on it to get that $1 million back. Okay, so again, the first one here, first problem gives you the net cash inflow that you're receiving. Second, if it asks you operating income, the differences between cash inflow and operating income is the depreciation part. So remember, operating income is an accounting tool. If we go back to accrual accounting, we always considered some of the expenses and revenues that, even though it's not actual cash inflow, cash receipt or cash payment, we still want to decrease it from the income that we're receiving. Okay, so we estimate that an asset's value decreases $1,250,000 every single year of its usage. So the operating income becomes this, $1,408,240. So from this information here, how do we get payback period? How do we know how long it takes for us to cover the initial cost? So how many years will cover the initial cost, which is the $13,500,000. So that is the initial cost that we're covering. Then we divide it by this number, not the operating income, the net cash inflow. Okay, so remember, payback period, we're using net cash inflow. Only rate of return, we use operating income. Okay, so payback period will be calculated like this. We'll give you 5.1 years to cover the whole thing. Okay, so after the expansion and after every single year's usage, it takes you 5 years to make this year's revenue that you're getting, the cash inflow, to cover the initial cost, $13 million. Okay, what about rate of return? Rate of return, we will be using the operating income, which is the one we got, and then divided by divided by 2, right? So the initial cost plus the residual value is $1 million divided by 2 will give you the rate of return. Okay, so you'll be using the first problem's the operating income you got from the second problem divided by the average level of the investment, which is the initial cost of the asset plus any residual values divided by 2. So again, what this ratio means is per dollar of average investment in the asset, how much operating income you're getting on an annual basis. So here we're getting 17 cents from every dollar of average investment we make to the asset. So this problem doesn't really tell us what is their desired rate of return. So assuming it's 15%, then this rate of return actually is pretty ideal because it covers the desired profit. If it's 20, then we probably need to think twice because this doesn't cover the desired profit. Okay. So you'll be using this ratio not by just looking at itself how high and low it is, but comparing it against desired ratios or comparing it across different projects. Any questions so far in the first two analysis tools? So the first two that we mentioned here, again, is just usually used for managers level at a screening process to determine which projects that really takes too long to recover the initial cost and which ones the rate of return really is not ideal compared against their desired profit. Now for longer long-term assets investment projects that takes beyond 5 years, typically to 10 years, 20 years, we also need to consider the very important factor, time value of the money. Okay, so let's just cover briefly before we go into the tools, what is time value of money? Basically, it's the idea that the money you invested now actually earns income as time goes by, even if you don't add additional investment to it. So the $1 you have right now is actually is actually more valuable than $1 you're getting next year. Because the dollar you have right now, you have the option to save it in the bank, you have the option to purchase stock, you have the option to purchase bonds, and a lot of these will give you a return as long as you make your investment choice carefully. Right, so this return, perhaps later on when it comes to next year, the beginning of next year, your dollar becomes $1.50 or $1.10, and that will be different from the dollar you're getting next year. It will be more than the value of $1. Okay, so the investment you make nowadays, same for the companies, the investment they make in a certain projects, the return they're aiming to get from later years has a value as time goes by. You get $1,000 next year, you can invest it in different investment tools, certificate deposits, you can invest it in different stock markets. You'll be earning money as time goes by. So the two of the analysis tools we use for long-term assets decisions making, we also will be considering net present value of the return. So going back to that $60,000 of investment return we're getting, if it takes 10 years to get all the $60,000 return, what is it worth right now at this time point? So we'll be comparing different projects based on the different annual returns. Which one is more ideal than others? We also need to consider what is its present value. So to make these projects comparable, we want to know what is the present value of these return, which one is higher than the other. Internal rate of return, this is the last tool, also factors in the present value idea. Okay, so let's just briefly review, even though perhaps some of the other courses you already learned this. Remember that some of the factors that affects time value of money, when we calculate the present value, future value, it's important to know these three factors first. So of course, what is the time periods of the return for each and every investment project? How long does it take in order to get, what is the lifetime of the assets, basically, is the number of periods. Interest rates, what is the current interest rate that we will be getting if we invest this money elsewhere? What is the return that we're getting? The percentages that we're earning from these return that we get on an annual basis. And then of course the principal amount, which is the $60,000 you're getting every single year. So different problems you'll be earning, different problems, different projects, you'll be earning a different rate of return, different principal amount. So altogether, how does it factor it back to the current time point? Which one gives you a higher present value than others? So these are the factors that we need to consider. Well, you'll need to consider when you look at each and every problem. Ask yourself, what is the principal amount here in this problem that we need to take care of? And what is the lifetime of the asset? And what is the interest rate that factors in calculating present value or future value? So principal amount, let's just review. There are, generally speaking, two different types. You could be getting a return altogether, just a one-time return we call a lump sum return. Or like the previous B2B example that we went over, an annuity return, $60,000 every single year. Okay, so these two types, you will be using different present value factor or future value factor to consider the value. Because if it's annuity, then every single year you're getting $60,000, you have interest factored into each and every one of these returns. But if it's an altogether return, $360,000 that you're getting 5 years from now, that interest you will not be getting in the middle of these years. Okay, so lump sum return, annuity returns, how we calculate a present value is different. Interest rate, there's also two types. Simple interest rate, compound interest rate. So these two, the difference is that interest calculating only on the principal amount is considered simple interest rate. So if you look at this table, this is an example. 6% of interest rate multiplied by the $10,000 every single year just by the principal amount. We're not considering the additional $600 interest. We're not factoring that in. Factoring that in, the interest calculation will be compound interest. Okay, so compound interest assumes that the interest that you earn over time is also kept and calculated for next period's interest that you're getting. So as time goes by, the interest you're getting actually increases along the time frame. So throughout the chapter, we'll be assuming that we're getting the interest rate as compound interest because this is closest to reality. Simple interest usually doesn't fit most of the cases here. Okay, so again, 3 main factors for each and every problem. Try to figure out what is the principal amount that they're talking about. For different projects, the annual return they're getting is different. And then what is the interest rate that they're getting from this investment? Are they investing in personal cases? Are you investing in certificate deposits? Are you investing in savings account? These gives you different interest rates. So when you calculate present value of your investment will be different. Time periods. The investment projects, does it last for 10 years or does it last for 6 years? And when you look back at the appendix tables, the factors, the rows and the columns you'll be looking at will be different. For different time frames, different percentages. Okay, so generally speaking, present value and future value, the difference is the interest that you're getting in the middle. So the example we went over, let's assume that you have principal amount right now. You want to invest in, for example, you open up a certificate deposit, you deposit in $10,000 now. Assuming that you're getting 6% of the interest every single year, after 5 years or 6 years, perhaps the value becomes $13,383. So that is the value that you're receiving after the certificate deposit. You release your money, then you're getting the $13,383. The differences between the present value and that future value is the interest that you're getting in the middle. Okay, so another way to look at this is that, let's say 5 years from now you're receiving this future value. You may want to know what is the value of that money as of now, as of today. So then again, that difference is the interest that you earned in the middle of the years. So that money, if you deposit in something, you choose an investment options, just leave it as it is. It generates money as time goes by. This is the idea of interest, and that makes the difference of present value and future value. Okay, let's take a look at, if you have your book, appendix, anybody has your textbook right now? Appendix B, you'll be using this, and make sure on Friday you bring your book. So it's quicker, you can refer to the table, some of the annuity factors, present value factor, future value factor. It's important to, basically it's this table. So we'll be looking at different time periods, different percentages. What is the present value factor that we need to use to multiply the amount to calculate present value of the investments? So for example, again, going back to that $10,000, if you invest right now $10,000 in the CDs account for 5 years, and assuming you're getting 6% of interest, to calculate that future value of the $10,000, you'll be referring to this table, 5 periods, 5 years, and then the interest rate 6%. This will be the number you use to multiply that $10,000 to get the future value of that investment. Well, you multiply that number by 10,000. If it's 20, multiply by 20,000. Okay, so the table there gives you the basically $1 of investments number that you need to multiply by. Okay, so whatever the investment, if it's 20, then you use $20,000, multiply this factor here. Yes, definitely. You don't have to memorize these, of course not. Okay, so these will be given to you. It's just easier if you have the table with you when you do the exercise. Okay, so if I tell you this $10,000, you do investment for 4 years, and the interest rate is 3%, then you'll be using this 3% multiplied by 1.12 to get the future value. Okay, so this is a lump sum investment, assuming that you just put in the money as of now. You don't have additional money going into that account. Putting in the money once, and then that's the end. After 5 years, you're getting this dollar amount. Now, what if you're investing money constantly into an account? So if you're investing money constantly into the account, this is the idea of annuity. So if every single year you invest in $2,000 to the account, $2,000 to the account, you refer to the annuity table, which looks a little different. Okay, basically, every single year you're getting $2,000 increase in the account. It's not like the $10,000 you invested in day one and then you collect it after 5 years. So this part here, after first year, you have $2,000. After second year, you have 2,000 plus 2,000 multiply 6% of interest. After the third year, you have 2,000 plus 2,000 multiply 6%, and then you multiply the whole thing by 6% again. Okay, so the table you're referring to here, after 5 years, again, 6% of interest, you use this to calculate the future value. So basically, the table gives you a shortcut. You don't have to worry about how many years there is and use the 2,000 multiply 6%, then multiply 6% again and again. Just refer to this table as just a one-step process. You use this ratio here, multiply by the investment, $2,000, if it's an annual investment that occurs every single year. And you refer to the annuity table. Okay, so when you go back today, look back at the appendix. There's 4 tables there. Present value, future value, lump sum investment, annuity investment. Try to kind of play around with it. You can do a little bit of investment analysis your own. If you deposit $1,000, assuming bank interest is 2%, you deposit it for 3 years, every single year, how much are you getting at the end? This is compound interest, yes.